Good afternoon, everybody, and thank you so much for joining us today. I am so thrilled to have such an excellent group of contributors here who've sent me so much excellent information on global financial markets. Just to read the room a little bit, who is currently trading gold? Interested in gold price? Okay, who is also interested in who might win the presidential elections in 1 month from now? Excellent. These are all topics that we're going to be discussing today, and with that in mind, I'm going to jump straight into the first question, and I'm going to start with you, Patrick. So, 2024, it will be remembered and looked upon as unprecedented. We've had record highs and all-time levels across so many different asset classes. Major markets, gold, Bitcoin, even the price of cocoa. What themes and factors would you say has driven investor behavior so far this year? Please, Patrick.
Thank you, and it's a privilege and a pleasure to be here. It's such a great event. For me, what we're looking at is really a somewhat an existence of the bond market bullying the Federal Reserve, and now the bond market has come to heel to agree with the Fed and the projections of interest rate cuts. We saw a blowout of non-farm on Friday, and we had this situation where in the beginning you had January at minus 170 basis points of cuts, which is way, way extreme, coming into now both at 50 basis points. So 2 cuts essentially. We feel that gold and S&P should benefit whatever the Fed does from here till December, because it's a Goldilocks situation, and there's no more talk of a soft landing, it's talk of a no landing.
Okay, Naeem, how about you?
First of all, I wanted to applaud everyone because this is the second day, and usually in the afternoon you don't see that many audience, so we greatly appreciate your time for this particular one. And I agree and concur the fact that we don't know when this wave began whether it was going to be a hard landing, soft landing, and then there were conversations of no landing. From a trader's perspective, this is what I look at. Going into the meeting, the US non-farm payroll data and the FOMC minutes which are due this week. By the way, this week is going to be humongous because we have the CPI FOMC minutes. The thoughts were that for some reason traders were very much focused that there's going to be another 50 basis point cut and the US NFP is going to be not that great at all, but obviously we've seen highest increase in the household employment, which was a very strong signal that the economy is still on strong footing. From a trader's perspective, yes, we are possibly not going to get another 50 basis point interest rate cut. But more importantly, if you are a trader and you have been trading for the last decade or so, what are your thoughts when the Federal Reserve begins the dovish monetary policy cycle? Does the market usually goes up or does the market goes down? Ostensibly, the market would go up because market loves that. So even though the data came very strong, traders should not fear in terms of the equity market. I'm not speaking about the gold, because I'm sure you will have plenty of questions to talk about that. In terms of the equity market, the path of the least resistance is very much skewed to the upside because economy is solid, more interest rates are coming, and thirdly, which is the most important one, corporate earnings season is about to begin, and we're going to hear a lot of fundamentals in terms of where the CAPEX spending is in relation to what? The biggest theme that we have seen this year, and that is your artificial intelligence.
Thank you, Naeem. So we've got soft landing, we've got interest rate expectations. How about you, Slobodan? What themes and factors are you watching or you think's driven investor sentiment?
First of all, 2024 was so far extremely specific. We have seen things that never seen before. I believe that this is not the end, and that things to be seen, surprises to be seen, are still to come. Due to the situation, particularly geopolitical situation, which is not promising at all, plus elections in the US, plus all the story with the interest rates, uncertainty in the market, gold running to its record highs, Bitcoin running to its record highs. So things are changing quickly. I was 2 days out of the office, and just today I checked the news and I saw that I missed a lot of things within 2 days. So the things are just moving. So I guess will be a lot of turmoil in the market. Talking about US economy, I believe that the situation is worse than it's presented at the moment. This is my personal view. I judge it from the situation when we had the crash of Asian stocks 2 months ago, just on the rumors that might not be soft landing, might be something harder. So things are still unclear. So I think all these things will be just adding fuel in the fire and driving the markets continuously through the end of 2024 and the early 2025.
Thank you so much, Slobodan. Hale, how about you? What themes and factors have you said driven investor sentiment this year?
I mean, 2024, we've had if you look at AI, for example, AI fever's there. Tech stocks are on the rise, hitting highs. In terms of interest rate policy, interest rates are starting to come down. So factors like this are going to drive the markets. These are, ideal conditions for stock markets to invite investors in and go from strength to strength. And also we've got the US presidential election in a month's time. If one person was to win, talk is that it's more business friendly and so on. So I think the factors are there for 2024 to finish on a positive note. I still think we have room to go to the upside.
So there's a lot, guys, to keep your eyes on. And one other factor that we have to watch is geopolitical uncertainty, and that's our second topic for today. So with regret, we are still facing a different number of geopolitical uncertainties globally, and we are sadly still seeing further escalations. So, should geopolitical uncertainty continue to, with regret, escalate, what potential trends could this bring to global financial markets? And once again, I will start with you, Patrick. Thank you.
Thank you. Yeah, I mean, to be honest, the markets are taking this quite well at the moment.
Yes.
You've got S&P new highs, gold really firm, especially after a stronger non-farm, which usually, when dollar goes higher, gold gets a little bit softer. Really holding it really well. I do feel, yes, oil is higher, but nowhere near the previous highs on geopolitics. So at the moment, it's carry on. And, the focus is obviously how much more the Fed will cut. Yes, of course. And I think often the markets take things and price things quite quickly. So whilst it is a concern, if you look at the volatility models in, say, options and some of the implied volatility, things are looking okay. They're not roofing it off the charts. The only chart is some concern. Some of the inflation charts in the US on surveys like University of Michigan are much, much higher. So we might be in a reflation trade. That could be a concern for the Fed. So that's the only thing that might upset stocks.
So we're certainly going to have to watch out for that. So Naeem, how about you?
Generally, you would consider gold as a safe haven asset, right? And then there is this question of a strong correlation with the dollar index as well. The dollar, for simplicity purposes, has a very close relationship with the Federal Reserve's decisions. If Federal Reserve cuts rates, it has an impact. If Federal Reserve increases rates, it has an impact. And then that influences the price of gold. Now, when you look at the price of gold, especially going into the Friday, that was very, very important because the data came much better than the anticipation, right? So that means that the Federal Reserve isn't really pushed into the corner to do a lot in terms of cutting the rate. That was pushing the dollar higher. If the dollar is moving to the higher, to the upside, that means gold should be moving to the downside. Within the first 15 minutes to half an hour, we saw that textbook trade. I would say even half an hour was more than enough. Maybe 15 minutes was enough. And then we see a reversal. So the question that naturally comes to mind is why that we've seen a strong data. That means the Federal Reserve is not going to cut the interest rate. Dollar is becoming stronger. Why are we seeing improvement in the gold price or retracement coming back up? That brings you to that very important factor, and that is geopolitical risk. Geopolitical risk currently, as you correctly mentioned, is contained on many levels. Because if we were thinking all-out war, oil prices would go like what we've experienced back when Russia and Ukraine war broke out at that time. We are not experiencing that one, so that means the sentiment in the market is contained. But smart money is still hedging by using gold from that particular perspective. And lastly and finally, the important factor is going to be inflation, very, very important. Because with the current escalation, Iran is one of the main players in natural gas, not only oil, in natural gas. Mm-hmm. In the UK, we are walking into winter. If consumer bills, which we are feeling the pain, they've gone massively up. I'm sure you feel pretty much the same with your electric and gas bills. If natural gas begins to spiral out, what's going to happen? It's going to have a two impact on my pocket straight away over here. Firstly, I'm already paying a lot of money because of the higher interest rate. My disposable income is going down. Number two, I'm already deprived of a higher utility bills. And if natural gas begins to spiral to the upside, I'm going to have a less money in my pocket, just naturally speaking. And that means more trouble for the Bank of England to do what next? And then the same question is going to be also for the United States and for the central banks.
Thank you, Naeem. And Slobodan, how about you?
Many traders that I educate or help or advise ask me, what do you think, where will dollar go or where will gold go? And I always mention, last year in my comments, I said gold will go to $3,000. What supports my story is the geopolitical situation mainly, but strong purchases from institutional buyers like governments. So the gold is inflated from any other aspect. Considering that Fed is likely going to cut rates further, this is another push because the dollar will go down in this case. So the gold remains inflated. So I say you buy gold depending on your risk policy, but you are not going to make mistake. Having in mind geopolitics that are heating more and more every day, like today I read that Iran maybe made a nuclear test underground because there was an earthquake in the region and the rumors go around. So such a things, okay, there was no significant reaction so far on gold because this is a rumor, but still, such a things can inflate gold price significantly. So 3,000, I think it's quite realistic by mid-2025, depending again how the geopolitical situations will be developing in coming months. Current situation shows us that it's not promising at all. We hope that things will not escalate, but it's enough to have some rumors or bad news to create increased volatility in the market, adding to existing things such as politics, economic situation, inflation. I have to say that underlying inflation is still elevated and they haven't reached the target yet. So there are still a lot of things remaining open and a lot of speculations. What are they going to do regarding the inflation level and regarding the economic numbers that are coming? And this will be the key driver of Fed. So whatever happens, we have quite optimistic, I have quite optimistic view for traders. There will be a lot of volatility, a lot of opportunities for good trades, so just use them all.
I hear gold is an interesting topic right now. We're going to be talking about it on our next theme. But Hale, do you have anything else to add?
I think if we just take the question, you know, what effect do geopolitical situations have on trading or on traders or on the markets itself? I think they do. I mean, we're looking at a particular geopolitical situation that we find ourselves at the moment. But I think, you know, in general, yes, they do have an effect. There's going to be an increase in volatility. There could be, you know, normally assets would go to safe havens, so there will be, you know, buying of gold, buying of euro, buying of Bitcoin. But I think looking at gold, you know, gold could be much higher than this if we're looking at the situation that we're in now. But as Patrick said, the market has seemed to absorb it, priced it in, it's contained, it's not running out of control. But another factor to consider is that with the sanctions that were placed on Russia, for example, you might find that there are some central banks increasing their gold reserves, you know, because of that situation. So that could be another factor driving gold up. But do geopolitical situations have an effect on the markets? Yes, they do. It could affect on pricing, where you could get, you know, wider spreads, for example, volatility, gapping in the markets. All these factors are things that traders should, you know, take into account when, you know, putting together their trading and their risk management techniques while trading, because they will have an effect on your trading.
Thank you so much. I think all of us can agree that financial markets have been a bit more sensitive over the past week or so. And one asset, which each of you has mentioned in some way, is gold. I know it's a very popular topic for our audience. Let's talk more about gold. Is it just uncertainty and geopolitical uncertainty that's driven gold to such record highs this year? And secondly, I know Slobodan mentioned $3,000. Personally, I thought 2,500 was the ceiling for gold this year. Is there a ceiling in place? And what is that ceiling? And I will once again start with Patrick.
Thank you. I think you need to be a very brave trader to put a ceiling on gold right now. I used to trade futures over 15 years ago, and it hasn't changed since then. And the thing with gold is you're always going to have correlations that fall in and out of love. You've got the inflation hedge, you've got central bank buying physical, you've got the allure of gold with legacy family office buying it, you've got the anti-correlation with dollar, you've got risk on, risk off. And at the moment, we're in a really nice sweet spot for gold. So it's, for me, I think we could see a lot more upside. 3,000 perhaps. I think it will certainly start to slow down around the 3,000 mark. But you know, at the moment, if equities still perform the way they're performing, you have a no landing. You know, gold could pick all the good bits out of the macro and leave all the bad bits. That's my view. And at the moment, there's no stopping it.
I agree that correlation between major markets at a new all-time highs at the same time as gold is one to watch out for. Naeem, what factors are driving gold this year? And is there a ceiling in place?
I think, look, when it comes to gold, I'm going to say this particular element. If we take the geopolitical risk out of the equation, which currently is very much baked into the gold price, and we just focus on monetary policy, which is the Federal Reserve, and then the cycle of lowering interest rate, gold is immensely inflated with that particular element, because we've seen it in the previous cycles during the financial crisis. So I think that if you take the geopolitical situation out of the equation and just focus on the monetary policy, the path of the least resistance lies within the realm of consolidation for gold price. So it's going to be no massive moves to the upside, but perhaps more tilt to the downside. And this is despite the fact that the Federal Reserve will cut the interest rate. And then that despite the fact that we will see some more strength coming in terms of the dollar index. But if geopolitical events, they continue to anchor in place like the way that we've we see news and everything else, then I think it is incredibly difficult to put a bracket on anything under that circumstance.
There's a lot of uncertainty, and I think one metaphor you used there is what comes up might come down.
Yes.
Sobadan, how about you? What factors have driven gold, and is there a ceiling in place apart from the 3,000 US dollars that you mentioned before?
I would just add to his comment, if we take out geopolitics, we have inflation and monetary policy as a key driver. But we also have strong physical buying of gold in light of stories that are going around the BRICS and these new organizations. There was a story circulating that they are trying to introduce new reserve currency, which will be backed by gold. So they are buying heavily. China is buying gold heavily. Russia is also buying gold. So we have physical buying as a factor that keeps inflating gold price along with the monetary policy, along with the geopolitical factor. So we have quite good support. I agree that currently what I saw today on the chart, I didn't see the details, we can see some correction. My key support is 2,500. And I believe that the market will not exceed this support. In that case, we will have a sort of a reversal signal and probably deeper correction. Otherwise, I see the continuation of the uptrend. If it dips down to 2,500, there are other supports before this. So just buying on correction based on the current situation. If nothing dramatically changes meantime, we stick to the policy, to the strategy that is applied now.
So buy on the dip might be a potential strategy to watch. How about you, Hale?
I think I will have to agree with everyone on the panel here. I think if we see where interest rates are going to be over the next 12 to 24 months, I believe the dot plan is a reduction of, I don't know, 1.5% to 2% over the next year and a half. So I think the ingredients are in place to drive gold higher. I think there's an appetite for buy. Currently there's a premium, even if you want to buy physical gold these days, there's actually a premium. Normally there's, you can get gold at a bit of a discount, but these days there's a premium on gold. So I don't see why gold shouldn't continue to go higher.
Thank you so much. Let's move on to our next topic, central bank policy. As we all know, the US Federal Reserve cut US interest rates by 0.5% last month. Some of our panelists have already mentioned names like soft landing, hard landing. What I would like to ask, and I'm going to start with you, Hale, this time, is inflation still the major economic report for traders to follow?
It's either inflation or it could be jobs from a US perspective, but definitely I would say more so inflation than the job numbers. I think the job number surprised a few people on Friday, surprised the market, but the market got a hold of itself, got a grip of itself again, and then continued up. But yeah, I think you've got to keep an eye on where interest rates are going. I believe there will be further reductions, maybe one more this year, maybe. I don't know, with that job data on Friday, maybe that's put that on hold a bit, but Patrick will probably agree, disagree, I don't know, but he's probably the man to ask.
We're going to find out. Slobodan, how about you?
Inflation, I think, as a major excuse, recently inflation was excuse for everything, is fading in a while. They managed to drop it, but not entirely. If we just go back and see the history of inflation in past 2 years, the Fed, according to their action, they made the mistakes. Top economists did not recognize inflation running so fast high. If you remember the stories, they were saying it's transitory, it's going to eventually fade and return back. Eventually, it happened exactly opposite. Inflation bursted and went to 9%. And then they reacted with this massive policy tightening and the increasing interest rates and whatever. So I think this inflation will remain as a factor destabilizing or whatever we say. Simply, they cannot ignore it. But how they will go in the future, they surprised with the half percent cut last time. Now there are speculations, and if you follow the BET's predictions, they are moving from 25 to 50 basis points, depending on the day, depending on the situation. I will say it will be quite interesting to follow. Definitely, they need to cut the rates because economic numbers are not that good to keep such a high interest. But again, we live in the time which brings us into many situations that are not according to the rules that we know, and the reactions might be unconventional, but that's how it is. So I believe that they will continue with the easing policy as the only solution, particularly United States, but Europe also needs to do something because the European economy is in much worse condition than US. So definitely we'll be seeing some rate cuts in the near future.
I agree with you on Europe, but Naeem, for US central bank policy, are
Yeah.
you watching inflation, jobs, both, something different?
I'll keep it short and simple. I think both are very important, but the one of the data which we all can agree is in the contraction territory is your ISM manufacturing PMIs. And that is where you need to pay attention to at the same time, because that's an important economic number which feeds into everything. Now, how many cuts in relation to your question? I don't think it's going to be any more 50 basis point rate cut. I think it's going to be 25 basis point rate cuts, possibly two by the end, until the end of this year. It would be a very gradual ride from here as long as economic data continues to print the same trend. And I'm using the word trend with a lot of emphasis on it.
So I think what Naeem is saying, guys, is that lower interest rates might not be the medicine for economic data. Patrick, what data are you watching?
So I'm across all the macro in the US, and you know the City Surprise Index. I was on CNBC last night and was talking about the same thing. The City Surprise Index has two legs of it: one European data, and the other one US, and both have never been so wide. It's just incredible. So it's in fine fettle. It's in the US macro is in very good shape at the moment. Now, coming to inflation or jobs, it's a dual mandate, and the Fed has told us the risks of balance skewed more to the jobs. So now that's kind of done, we're now focusing on inflation. I see an upside surprise as a major pain trade for those dollar bears, and the interest rate cuts could get repriced. And there are some desks that I've been speaking to this week are calling for a hike maybe in Q1, Q2, if we continue with robust jobs and inflation does tick higher. So that's the problem. That's going to be a nasty dollar squeeze, and it will be really, really painful.
I think that might be a trend to watch out for towards the end of the year. Our next topic, guys, is an event that's taking place in just under 1 month from now, the US presidential elections. Before we dive into this, I just want to have the full room in front of us. Who thinks that Kamala Harris might win the presidential elections next month? Who thinks that the previous president might return and be in the White House once again? Okay, we've got excellent panelists on the stage as well. Guys, this race is neck and neck, 50-50 if follow those prediction markets. So what potential trends could we see if hypothetically either candidate wins? So what might we see if Kamala Harris becomes the next president? What might we see in financial markets if the previous president, Mr. Donald Trump, returns to the White House? And I will start with you, Patrick.
I'm not going to give a clear-cut answer, but for me, it is quite clear in how much chowder is in the result. Now, we've done quite a lot of work with Alpine, and the net result is if Trump gets in, it's going to be more tax cuts, both personal and corporate, but higher Chinese tariff imports, right? So there's the net of that. Harris gets in, there's going to be less China import tariffs, but less personal and corporate tax cuts. The net of that is if US companies decide how they're going to wear their MAGA hats and buy America first or not. That's the problem, and we're not really sure. For me, it's going to be very, very difficult trade. I traded the last Trump win, and that was a lot more clear-cut. Buying dollar yen was a given on the victory speech alone. But dollar yen was at 101, right? Today, this year, it's going to be a whole different ballgame. And right now, it's anyone's guess.
I would say that nothing's been priced in. Naeem, how about you? What do you think about this?
I think everyone pretty much has given their answer that Trump is going to become the next president. So with that in mind, the stock market is naturally going to perform well if he comes back to the office.
Make America great again?
Whatever you wanted to say it. But yeah.
Where's your hat?
Yeah, from the stock market perspective, oil prices will move to the downside because drill, baby, drill. That is what he's going to do. Fossil energy, fossil prices would obviously be impacted as well because he's going to be going towards coal. So from that particular perspective, I think that both candidates, without saying too much, I don't think they should be where they are as a leader of the two parties. That's what my unofficial opinion is. But picking among the two, I think Trump will do better for the economy.
Okay. Slobodan, please talk us through what scenarios, what impacts we might see in financial markets if either candidate hypothetically wins next month.
I will be trading as I trade the news, like NFP. So I don't expect something spectacular and long-lasting impact on the market. There will be, of course. So I'll be trading that news. Who will be in the White House? U.S. foreign policy has been written a long time ago. So the individual who is obtaining the presidential role has not much space to maneuver. It can go a bit left or right, but general direction has been written, has been prepared. So they have not much. Okay, a difference between Trump and Harris. First of all, Trump is much more charismatic. He's politician. Harris is, compared to him, amateur, but she has a strong team of Democratic Party behind her, so they do the job. Regarding their policies, again, Trump will be forcing this Make America Great Again, so we can expect the industry to start raising again. We can expect these taxes on China. He has speak on China. Lately, he became very hawkish on Iran again. Recall that there was an order to attack Iran during his previous term, and he called it back minutes before it was executed. Now he's becoming more hawkish again. So this geopolitical factor or war factor is present with both of them. Harris definitely is pro-war, so we can expect, let's say, the defense sector to be booming, to continue booming as they are now, having a good time. As I said, no spectacular impact on the market for a longer period, but some impact will be, and trade it as trading news.
Thank you, Slobodan. Hale, do you have anything to add? What themes, what factors you might be watching if either candidate might win?
I mean, out of the two candidates, it's clear that if Trump wins, it's more favorable for business, taking tariffs versus lower taxes, and vice versa if Kamala Harris wins. But I think there could be a third scenario, is that it might be positive news when the result comes out. So the certainty in itself of the result could have a positive impact. But I think from a market's perspective, from a trader's perspective, I think you look at a Trump win, much more favorable for business, especially in the defense, in the energy, and in the financial sector.
I think it's clear from reading the room that the former president seems to be the candidate of the room to win the White House. I remember last time he was in charge, social media played a huge role on financial markets, specifically based on somebody's tweets. Yeah. So my next question, is what impact do you think social media and information plays on investor decisions? And I'm going to start with you, Patrick.
Apart from Trump tweeting, we don't really follow that. I mean, there is this, consensus around some of the kind of noise, but we tend to steer away from that. So, look, if we have a situation where Trump gets into power, yeah, I'm all over his tweets. But apart from that, it's just not an area we would look at. So we leave it to somebody else. We're not the experts on social media.
How about you, Naeem? Are you going to be watching the Twitter feed?
Look, I think including me and a lot of institutions, they very much already have seen the season 1, so they know what to expect in terms of a season 2.
Yeah.
So market will be very much prepared for that. But one thing that I wanted to add to your previous question, and then what we all discussed, was I think 2 scenarios are very important when it goes to the US elections. Number 1 is whoever comes to the office, but who controls the House and the Senate, because these are very, very important parts where institutions are looking at very closely. Number 2, what if elections are stolen? That would create a huge chaos in the country. Like Trump he could encourage his followers to create huge chaos. And then people will do that. And that would be very bad for the market.
Okay, how about you, Sabadan?
I would just like to add to his comment. It was a few days ago in the media. Trump said, if Harris wins this election, this is likely to be the last election in the history of the United States. So it says everything. So very likely that we have chaos scenario in case he doesn't win the election. At least that's what he forecasts.
Okay, and Hale, what role does social media play on investor decisions? We have time for one more question after this.
I mean, it depends obviously who's tweeting it, but you do get not just presidents, but chairmen of certain companies who will tweet something, and it could, we have this Mr. Musk, yeah. So you do get, sometimes the risk is that you get some misinformation out there, and then you get this herd mentality of trying to get into something that is just not there. So you do get slight movements in the market, but I don't think it's a major effect. Obviously, everyone's going to be watching the X account of Trump, whatever he wants to call it this time. But I think what you might get a different Trump in, as Naeem said, season 2 than you did in season 1.
So guys, we have room for one final question. And I think all of us agree that the purpose of this panel is for investor education. And we have an excellent group of panelists with us today, and I thank all of them for their contributions. The question I have for each of you, and then we have to sadly wrap it up. What resources and educational tools would you suggest to our esteemed audience that maybe they can use and watch for their own investor education journey? And I will start with you, Hale, if you do not mind.
I mean, there is so much information out there at the moment in terms of where you're looking for trading guides or market analysis. There's so much information these days with the internet out there. So as well as every broker that's here today, we at Hantech, we have the Hantech Learning Hub. So there's so much, guides, informations, both on trading technical analysis or trading on, trading the fundamentals, and for all sorts of levels of trader, from beginner all the way, it can be as sophisticated as you need it to be as a trader. So it's a fine time to trade at the moment with the level of information and the standard of information that is out there at this particular time.
Thank you so much. Sabadan, anything to add?
As a dinosaur of the industry, I have 30 years of experience. I see the trading as an economy, sitting on 4 pillars. We have technical factor, we have fundamental, we have psychology, and risk policy. If you remove one of them, that share will not be stable anymore. I've seen many people losing money on not being informed well, not knowing what's going on in the market, or simply ignoring the news or ignoring technical signals. But this all falls into the chapter called trading psychology. Believe it or not, but as a traders, we are the biggest enemies to all our investments and all our money. All traders should work on their behavior. They should put themselves in the order to be 100% disciplined, to follow the rules that they impose. That's the only way to reach the stars, I say, because when you have, let's say, 8 out of 10 profitable trades, you are doing very well. But you have to beat yourself. You have to learn how to control yourself, not to go in the situation when you have today 1 million profit and next morning you have 0 because of stupid reaction. You did not protect your profit. So this is the, for me, key factor. Of course, including the other 3 pillars that hold the trading.
Thank you so much. Sadly, guys, we are running out of time, but I very quickly want to get to our final 2 panelists. Educational resources and tools. Any suggestions or preferences, Naeem?
I think there is plenty of material as compared to today, what we have in the market now as compared to a few years back. And that just tells you how much money brokerage companies, education and trading academies are putting in, including the free information which is available. Honestly, with my humble opinion, I will only say one word, and that is discipline. If you can train yourself, follow the strategy, have discipline, that is above and beyond any jingle bells that any platform is going to give you. And that's all.
Thank you so much, Naeem. And Patrick, do you have anything to add?
Yeah, just really quickly, I would say do your research and coming up, discipline, risk management, and find a mentor who's been there and done it. If you want, you can contact me directly on LinkedIn, and there's so many guides out there, but please do your own research. And it's never been easier, but in the same way, there's so much information, it's never been harder. It can be quite overwhelming. You just need someone to take the macro, turning it into tradable macro. So I'll leave it with you, but just do your own research.
Gentlemen, it's been an absolute pleasure to have you on this panel today. We covered such a wide range of different assets, themes, topics. I want to thank all of you for your contributions. And also I want to thank our audience for being interactive. It's been a pleasure to moderate this panel as well. Thank you everybody for your time and enjoy the rest of the event.